Good afternoon, dear friends. Today we are going to start the Provident Fund scheme under this. This is one of the topics which comes under the head income from salaries. So today we will be discussing some salient features of the various Provident Fund schemes, and we will also try to discuss the treatment of Provident Fund scheme as far as taxation is concerned. Means from tax point of view, we will see what are the provisions they are in under the Income Tax Act 1961. So, as you know that the Provident Fund schemes, they are the welfare schemes. The Provident Fund scheme is a welfare scheme which is set up for the purpose of the welfare of the employees and their families. Basically, the Provident Fund scheme that is set up for the welfare of the employees and their families. Under this scheme, the employer, he deducts a certain amount or a sum of amount from the salary of the employee, which is called the PF contribution, Provident Fund contribution, and also he contributes certain percentage of the salary, subject to some limits. He also contributes certain percentage of the salary as his own contribution, and both the employee contribution as well as the employer contribution, that is both the contribution, they are invested. The interest which has been earned on such investment is also credited to the respective PF accounts of the employees. So in this way, the accumulations, it keeps on, means the balance keeps on accumulating year after year. It means, first of all, the employee's own contribution is there, employee's contribution would be there, then there would be employer's contribution, and plus that interest would be there. So it means this contribution that will be deducted from the salary of the employees by the employer. Similarly, employer will also contribute certain percentage of the salary of the employee, and both these amounts would be invested, and the interest would be earned by the amount, and that the interest would also be credited in the respective account holder, Provident Fund account holder of the employee. So this is the way his balance in the Provident Fund account keeps on accumulating year after year. So the amount becomes payable to him at the time of his retirement or superannuation or death or his resignation, subject to fulfillment of certain conditions. So this is the way the Provident Fund scheme works. However, there are three important things which arise from the discussion of this Provident Fund scheme. These are very, very important to know at this stage. After this, we will discuss about the various Provident Fund schemes which are available right now in India. So, before we discuss the various schemes available, I just want your attention that there are three pertinent points which are worth noting. Number one point is that I am just talking about that contributions which have been made by the employee himself, by the employer, and the interest. So, these three things, they have just emerged out of that. So number one is that, as I just told you, that certain sum of amount from the salary of the employee is deducted every month from the employer. If you kindly see that deduction is made out of the taxable salary of the employee. It means the amount which has been contributed by the employee out of his salary to his Provident Fund account. It means this amount has already been paid out of the taxable salary, out of the taxable amount. So any contribution which has been made by the employee out of his salary shall not be again subject to tax. It means the contribution which an employee is making to his Provident Fund shall not be subject to any tax, because this particular contribution has already been made out of his taxable income, which has already been subject to tax. He might have paid the tax on that. Rather, please note it that employee contribution will enjoy some deductions under section 80C, subject to certain limits. It means the contribution which he has made to the Provident Fund may enjoy, these contribution would enjoy some deductions from his gross total income. So number 2 point is that employer's contribution. Employer also contributes a certain percentage of the salary of the employee as his own contribution, and this employee's contribution and employer contribution, they just form the corpus of the individual employees along with the interest on their end. But in this case, if you just kindly see, the contribution which has been made by the employer, the some percentage of the basic salary of the employee, that contribution shall be deemed to be the income which has been received or deemed to be received by the employee. It means if an employer, for example, if an employer is just paying 10% of the salary and DA of a particular employee A, it means this 10% of the salary, for example, the salary of Mr. A is say 10,000 rupees along with DA. DA means DA which forms part of the employment. So 10,000 per month is salary and he is just paying 10% of his salary income every month to his provident fund. It means that 1,000 rupees. It means 1,000 rupees shall be the amount which shall be deemed to be received by the employee A over and above his salary. So now this 1,000 rupees per month is not payable to him immediately. It would be paid to him only under certain circumstances only, means after retirement or superannuation or subject to certain other conditions which are prescribed herein. So that income means the employer contribution shall be deemed to be the income which has been deemed to be received by the employee. Now it is not payable at that period. So this is also worth noting. The third point is that the interest which is earned by the employee on account of his own contribution as well as on account of the contribution which has been made by the employer, that interest shall also be the income deemed to be received by the employee during the year when this income has been received. So these are the 3 points which are worth noting in connection with the Provident Fund schemes. Now we will just try to discuss what are the various schemes which are available under the Provident Fund schemes. Basically, there are 4 types of Provident Funds in India. There are 4 types of Provident Fund. What are those Provident Fund? Number 1 is a Statutory Provident Fund. Number 2, now we will be just discussing the various selling features of these funds in detail. Number 1 is Statutory Provident Fund. Second is the Recognized Provident Fund. Third is the Unrecognized Provident Fund. And the last is the Public Provident Fund. So these are the 4 public provident funds. These are the 4 provident funds which are available. And first of all, we will just discuss Statutory Provident Fund. What exactly is the Statutory Provident Fund? Statutory Provident Fund is a fund which has been set up under Provident Fund Act 1925. And this Statutory Provident Fund is meant for the government employees, semi-government employees, employees who are working in the universities, or the employees which may be working in any educational institutions which are affiliated to these universities, these educational institutions, or it may be meant for the employees which are working in specified institutions and may be prescribed by the government. So basically, the Statutory Provident Funds, they are just meant for the welfare of the employees who are working in government, semi-government, universities, or educational institutions which are affiliated with universities or some other notified institutions. So this is the salient feature of a Statutory Provident Fund. The second type of Provident Fund is the Recognized Provident Fund. This is a very, very popular Provident Fund. This is a Provident Fund, this is a scheme to which the EPF and MP Act 1952 applies. EPF means Employees Provident Fund and Miscellaneous Provisions Act 1952 applies. Under this scheme, under this Provident Fund scheme, any employer, please note down, any employer who employs 20 people or more in his establishment, he is under statutory obligation to register himself under the PF Act 1952 and start the Provident Fund scheme for his employees after 3 years of his establishment. That is the statutory requirement. It means if any employer has employed 20 persons as his employees, then he is legally bound to get himself registered under this scheme. This scheme of he is required to register himself under the Provident Fund Act 1952 and he will have to start the Provident Fund scheme for his employees after 3 years of establishment. But I mean, there is some relaxation to that. If apart from that, that is a statutory requirement. If the employer and the employee, they just wish to start the Provident Fund scheme earlier to 3 years, they can do it. It means that depends upon the voluntary wish of both the employer and the employee. So there is no debar. There is no restriction on that. They can't do it. They can do it. It means both employer and the employee, if they wish to start some scheme earlier to the 3 years, they can do it. And again, there is no restriction that there should only be 20 people. Even if both employer and the employee, they agree, they can start the Provident Fund scheme even if there are less than 20 people in the establishment. So there are two ways by which they can start this Provident Fund scheme. Number one scheme is that, I think you might have understood, because these provisions are very, very important. First of all, this Unrecognized Provident Fund applies to the employer who employs more than 20 people or more. So he will have to get himself registered. But apart from that, if the employer and the employee, they just voluntarily want to start something on this Provident Fund scheme, there is no debar on it, there is no restriction on it, they can do it. There are two ways by which they can contribute to the Provident Fund scheme. Number one is that they can contribute to the existing scheme which has been set up by the Government of India. This is an existing scheme which has been set up by government and is run by the Provident Fund Commissioner. This is the existing scheme. It has been set up by the government and it is being run by the Provident Fund Commissioner. The second way is that they will have to create their own scheme. It means they will have to create their own trust, wherein both the employer and the employee contribution that will be invested in a manner specified therein. As a trust, they can do it. But for this, they will have to seek the approval of the Provident Fund Commissioner as well as the Commissioner of Income Tax. So, if these two approvals are there, they can also do it. So, this is a scheme. This under the existing scheme, this has already got the approval of Provident Fund Commissioner as well as it has got the approval of Income Tax Commissioner also. So, this is the one way. Another way, I just told you, they will have to set up their own trust. And for setting up their own trust, first of all, they need the approval of PF Commissioner, and secondly, they require the income tax, the approval of Income Tax Commissioner also. Income Tax Commissioner. So, if they have got the approval of Income Tax Commissioner, then the corpus which is there under the trust, the money shall be invested in a manner as will be specified. It means only then if that is there, if approval is, they have got the approval, then the income of the trust is also exempted under the Income Tax Act. So these are the two ways by which the Recognized Provident Fund scheme may work. So in a nutshell, first we discuss the Statutory Provident Fund. Next is the Recognized Provident Fund. Third scheme is called the Unrecognized Provident Fund. Now, what exactly is the Unrecognized Provident Fund? We'll just discuss it. The Unrecognized Provident Fund is not so popular, but what exactly is that? Discuss. The Unrecognized Provident Fund is a scheme, you can say. Unrecognized Provident Fund is a fund or a scheme which may or may not have the approval of PF Commissioner. It means Unrecognized Provident Fund is a scheme which may or may not have the approval of Provident Fund Commissioner. It may have, it may not have. Number two, it shall not have the approval of Income Tax, Commissioner of Income Tax. So, when any particular scheme has got the approval of Provident Fund Commissioner, but it does not have the approval of Commissioner of Income Tax or Income Tax Commissioner, that scheme is called the Unrecognized Provident Fund. So these are the two important features of Unrecognized Provident Fund. The last scheme is the Public Provident Fund. The Public Provident Fund is a scheme which has been set up under the Public Provident Fund Act 1968. Under this scheme, any person, any assessee can contribute an amount to the Public Provident Fund, subject to certain conditions. This Public Provident Fund is available to all the people, irrespective of the fact whether he is working or not. Even if, for example, if a person is working and he is just contributing to his usual provident fund, which will be recognized or unrecognized, apart from that, he can also make the contribution to the Public Provident Fund. The minimum amount of contribution per year is 500 rupees, 500, and the maximum amount which he can contribute in a year is 70,000. So this is the minimum limit, and this is the maximum amount which a person can contribute. Another important feature of Public Provident Fund is that here you are not having any employer contribution, because you are not having the employer. This is a scheme which is just in which scheme you are just making the contribution from your own pocket. Your employer is not going to contribute anything in your account under the Public Provident Fund scheme. So it is a sort of self-generating fund, means you are contributing the fund and the interest is being earned by you on account of your contribution year after year. It means this is a scheme which has been generated by you, and it also enjoys income tax exemption that we will just discuss later on. So after a period of 15 years, you can take away the amount. Means amount of your own contribution as well as the interest thereon, unless it is extended. Again, it can be extended for a further period of 5 years. But 15 years, after 15 years, the amount is payable to you along with the interest thereon. Nowadays, the interest on the Public Provident Fund is 8% per annum. So these are some important features of Public Provident Fund schemes. So minimum amount is 500, maximum is 70,000. Any person can contribute, means self-employed, doctor, engineer, anybody, even a shopkeeper, he can also contribute to the Public Provident Fund, so that he can take care of those circumstances when he really requires the money. It means when he is going to contribute for his rainy days, because as I just told you in the beginning, these schemes, Provident Fund schemes, are the welfare schemes which are set up solely for the welfare of the employees and their families. So here you are not working as an employee, you may be a self-employed person, so you may also contribute. So these are the 4 schemes under which the Provident Fund is contributed. These are the schemes. Thank you very much.